Finance Explained. What's a mortgage? Meet John. He has been thinking about purchasing a home, but he doesn't understand precisely what a mortgage is. All he knows is a mortgage is used for buying a house or refinancing. Today's chat will help you understand mortgages, how mortgage payment schedules works, how interest rates affect your mortgages, and tips and tricks. Hello, this is La Mesilla Finances, where we discuss common questions around finances through whiteboard animation. Please remember to subscribe and like if you enjoy the content. A mortgage is an agreement between you and the lender that allows you to borrow money to purchase or refinance a home, and gives the lender the right to take your property if you fail to repay the money you borrowed. So in our example, John would put a deposit and the lender, which would be a bank or a corporation, would provide the remainder of the cash. Mortgage loans are provided for a length of time to pay back the loan with interest, and if a borrower does not repay the loan, the lender can sell your house to recoup the loss. Now, there are 3 areas a lender reviews to approve you for a mortgage: your job, your income, and if you have good credit as well as your debt. Let's say John has bad credit and he made a few mistakes, or he does not have enough income to purchase the home. Then a cosigner can come to your rescue. However, the cosigner will share the same level of burden if you do not pay the mortgage. There are 2 types of rates: fixed and adjusted. Fixed rates are interest rates that will remain the same over time, whereas adjusted rates can change depending on market conditions. For adjusted rates, the main benefit is you get a fixed rate for a period of time that might be lower than a fixed rate. It is encouraged that you refinance at a later time to a fixed rate. When paying for a mortgage, there are several types of payments you have to make. The first is the principal amount you have left to pay on the loan. The second is the interest you pay monthly, which is based on your interest rate and loan principal. And third, you need to purchase a private mortgage insurance, which is also known as a PMI, to protect your lender if you default on your conventional conforming loan. Now, a PMI is only when you don't have a direct deposit that's over 20%, so you can avoid this by having a larger deposit. As a homeowner, the amortization table is very important to understand. The amortization table refers to how those payments are broken over the life of the loan. In the early years, a higher portion of your payment goes towards interest. As time goes on, more of your payment goes towards paying down your loan balance, also known as your principal. Let's do an example with John. John is purchasing a home for $500K. And he has $100K as a down payment. He speaks to a bank and gets a loan for $400K at 5% APR for 30 years. Do you know what the total cost is after 30 years? Around $773,000. Here are my tips and tricks. The first thing I would do is Google Amortization Calculator to try different scenarios. The second thing I would do would be to ask multiple lenders to get the lowest interest rates. The third thing I would do is ask family or friends to provide larger down payments. And lastly, I would refinance if I have an adjustable mortgage. That way I have consistent payments in the later years. That's the end of this video. If you like this video, make sure you subscribe and like. Also, feel free to leave a comment below and share some of your own tips and tricks for mortgages.